straight to today's action and the quarter's action with our first guest, Rich Weiss of American Century Investments. Rich, well, how do we get here to these record levels for stocks in the first quarter? And what do you think it says about where we might go next?
Well, John, it's always hard when we hit new highs, a quarter like we just had, record quarterly growth in the S&P, to come on and be that guy, the cautious guy. I'd like to say the voice of reason. But in this momentum-driven market, right, it's basically a FOMO market at this point. Momentum as a stock driver, always worrisome, very fickle stock market driver, unlike valuations or growth or profitability. When people are investors are buying stocks simply because the stocks are going up, it's circular reasoning. It's like picking up nickels in front of the proverbial steamroller. So we'd definitely be a little cautious here. I'd love to come back on in 3 months. Let's talk after another quarter, because I do not see us repeating this quarter, as good as it's been.
Okay. Well, I mean, I guess it's not saying too much to say we won't repeat this quarter, but could it still be good from here? I don't know. Well, I want to move on to what you're saying about fixed income. You favor the safe yields there before we even get to the appreciation that would arguably come if and when we get the rate cuts that many expect. Tell me more about that and how much you lean into fixed income right now.
Only at the margin. We're not market timers. We don't move in and out of the market wholesale. So we're tilting about 5% into fixed income assets, along with some other tactical positioning within the stock market, small cap and REITs. But in fixed income, generally staying higher credit quality, a little bit long on duration. To your point, looking for the slowdown, that's probably the safe place to be. And with yields, with a 4% handle or better, depending on how low you go in the credit quality, if you do the math there, maybe a 2% drop in rates if it were across the board. We're not envisioning that so quickly. Average duration around 5-6 years, you can get quite a hefty appreciation, something much more attractive than what we see in some of the large cap growth stocks right now.
It's interesting to hear you talk about this, because what was so unusual about this first quarter is the fact that you had this torrid rally in stocks, but you also had gold reaching a record high. You had crypto and Bitcoin touching a record high. You had a big rally in crude and the energy commodity complex as well. The dollar re-strengthened, particularly notably against the yen here in recent days and recent weeks, and yet Treasury yields are higher on the quarter too. Is that a sustainable dynamic going forward, and how does it speak to dig even more deeply into your investment thesis around fixed income?
Right. We do not believe it's sustainable, not in the near term. Now, maybe by the end of the year, once we get through some of this market froth, right, or animal spirits, I think is a term I've been seeing lately. It's all part of this momentum trade that's been going on. Earnings, they're just not there. They're slowing down. Aside from tech and a few key names, many of the sectors of the S&P had negative or low single-digit earnings recently. So we don't see the fundamentals driving it. And with rates staying high, at least for the foreseeable future, you'd have to be a professional contortionist to find something positive in those latest CPI reports. So with rates staying higher, we're not going to see PE expansion here. It feeds into our outlook, which is relatively cautious, again, for the next quarter or two.
Okay. But if rates are staying higher because the economy is stronger and consumers are remaining at least a little bit more resilient than everybody had anticipated, isn't that actually a good thing potentially for earnings?
Potentially, but rates are staying higher because inflation's staying higher, and the Fed's afraid to pivot too early, per the governor's comments the other day. So it's not necessarily the economy is so strong. We see it as slowing down or decelerating with high inflation. That's not a great outlook for stocks.
Okay. Rich Weiss, great to get your thoughts today.